Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, December 4th. US announced very weak jobs data yesterday, the fourth negative ADP print in the last 6 months, if you will, giving the green light for faster and deeper interest rate cuts to the Federal Reserve. So US yields fell, stocks, especially this small one, spiked in the US yesterday. Meanwhile, optimism went a notch higher in Japan today after the sale of 30-year government bonds drew the strongest demand since 2019. So the Nikkei responded with a 2% rally in today's trading session. Alas, the technology stocks, especially the US ones, couldn't fully benefit from yesterday's rebound in US equities as AI worries resurfaced with news suggesting that Microsoft lower its sales target for AI products. That day denied, but the mood was not necessarily great. Oracle CDS spiked to a 16-year high, making investors further wonder whether it is time to further shift toward non-technology and non-US pockets of the market moving into next year. So we will talk about all that and more, but before we do, please keep in mind that opinions are my own and this is not financial advice. So the big news of yesterday was the US economy losing 32,000 jobs in November. And it's not AI's fault, it's because small companies with less than 50 employees shed 120,000 jobs last month according to the latest ADP report. And the latter outweighed job gains in bigger companies, obviously. So overall, 32,000 jobs were lost in November in the US. It is the fourth negative print in last 6 months' data. So on average, the big and beautiful US economy added less than 20,000 jobs over the past 6 months, a level that's comfortably pointing at recession in the US. Add to that, the big companies like Apple and Microsoft, they're also planning to reduce their headcounts, this time due to AI, and you have a pretty amazing picture for the financial markets. Because the job losses will force the Fed to cut the interest rates faster and lower, and if, on top of that, people just slow their spending because they don't have jobs anymore, and inflation slowed in the US, that would be the cherry on top. I mean, for investors, of course, that's odd, but that's exactly how markets process information and data. So yesterday was a typical bad news is good news session for the global financial markets. You could see the cheery mood across US assets yesterday, cheering the job losses. Yes, because they simply sent the US 2-year yield below the 3.50% level yesterday after the data release. The probability of a 25 basis point cut from the Fed in December rose to 90%, and the S&P 500 traded at 68-62 level, some 58 points or less than 1% below an all-time high level. Interestingly though, the technology stocks in the US are normally more sensitive to yields because a good part of their valuation are based on future revenues that get discounted to today. Didn't move much. The Magnificent Seven was stoic indeed yesterday. Microsoft was busy denying a report from The Information claiming that the company lowered its growth targets for AI software sales after many of its salespeople missed their goals in the last fiscal year. Obviously, it wouldn't be surprising for a company to set unreachable goals for its employees than to scale them back, but the latter really resonated among investors, among the AI investors, as you see, they are not selling enough AI-related products. They are lowering their targets, and all these AI investments are going to be garbage. So Microsoft shares closed 2.5% lower yesterday, while Nvidia lost 1% despite news that they could get approval for selling their chips to the Chinese from the US government if the Chinese are still willing to buy them, obviously, which doesn't look like the case anymore. Tesla, on the other hand, gained more than 4% for reasons I can't really explain. Tesla sales are crashing in Europe. The company warned that the UK sales are weakening as well. Michael Burry, the big short Michael Burry, called Tesla ridiculously overvalued. And I agree with him on this one because this company has just become a massive meme stock with a P ratio near 300. That means you buy the share for around $446.74 as per yesterday's close, and you earn around $1.5 per share. This is the simple way of putting it. So it is expensive, but some people like it. But on the other hand, there was a not so EV friendly news on the wire again yesterday. Trump just lowered the climate goals for the US, sending Stellantis, for example, that is struggling in the EV segment, up by almost 8% in Milano. So go figure why Tesla rallied yesterday. But anyway, overall, the US session was good. And the Japanese session was great because the sale of 30-year government bonds in Japan drew the strongest demand since 2019. You bet it did at the current yield, near 3.40% right now, which is a multi-decade high level. And given that the pressure in the JGBs was one of the major risks to global risk appetite and remains to be so because the Bank of Japan had on Monday hinted that there will be a rate cut this month probably from the Bank of Japan. Well, seeing the rally in JGBs sent the Nikkei up by 2%, I still think that it is fragile though. So the US futures look quite mixed this morning despite the rally in Asian equities. Nasdaq futures, for example, are even slightly in the negative at the time I'm talking here this morning. Maybe the news that Morgan Stanley is considering offloading some of its data center exposure didn't exactly please technology investors. According to their calculation, the big cloud companies will spend around $3 trillion on data centers through 2028, but their cash flow can fund only half of it. Oracle CDS, which has become the barometer of the risk in AI, also spiked. It spiked to a 16-year high yesterday, hinting that appetite among technology investors is fading. So investors are waiting for tomorrow's PCE numbers to further clear the way for rate cuts beyond December from the Fed. And at the speed of deterioration in economic fundamentals and US economic data, the Fed may not resist to further interest rate cuts come next year. The question is, will the softening Fed expectations and rate cuts be enough to turn the risk appetite around for the technology stocks? Or would it be just better to bet that the technology rally will broaden toward the non-technology and non-US pockets of the market? Because look, the Russell 2000, for example, rallied nearly 2% yesterday on the back of the miserable ADP report and the cocktail of fading AI appetite due to high AI valuations and lower yields that would benefit the small companies could direct funds toward these smaller pockets of the market. In the FX, the US dollar slipped straight below its 50-day moving average and tested a major Fibonacci support yesterday. If broken, we'll send the greenback into a medium-term bearish consolidation zone again. The broadly softening US dollar on rising dovish Fed expectations also sent the euro dollar above its own 100-day moving average at yesterday's trading session, as the Europeans are not considering moving their rates next year as inflation in Europe is around the 2% level. So that's pretty much the European Central Bank's policy target, and risks are being set to be two-sided. In Switzerland, the 0% inflation and insatiable demand for the Swiss franc continues to worry the Swiss National Bank, who doesn't want to cut the interest rates below zero. And if all goes well, the Fed cuts will be enough to lift risk appetite in global equities, reducing the rush to Swiss francs. And a Fed cut, by the way, is also excellent news for the European stock markets because they benefit from the positive echoes of lower US yields grandly, and investors also benefit from a stronger euro as well that makes their European investments even juicier in terms of US dollars. Elsewhere, if you're looking for something else, copper rallied more than 2% yesterday in COMEX on concerns that potential US tariffs will lead to a supply squeeze. Overall, metals are also among investors' favorites this year as appetite for all traditional currencies, all of them, is waning. So the year's end is coming with one important question. Is it time to move further away from the technology toward non-technology and non-US pockets of the market? A discussion that we were already having last year and which actually benefited to European stocks. EM indices, on the other hand, do well as well when the dollar is soft, and the European indices have performed incredibly well this year to close the valuation gap with the US peers. But there is certainly more there to take advantage of, so it's just that it is less exciting. But to be considered still. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.